There is a belief that has shaped how most income investors approach the market for decades. You buy undervalued stocks, you avoid overvalued ones. If a company is trading above what it is actually worth, you wait for a better entry or you move on entirely. It is a sensible principle, and most of the time it is the right instinct. But today I want to make the case for why blindly applying that rule to high-yield income investments can actually cost you money, and why two of the best dividend stocks I own have been consistently overvalued for years, and I've continued to hold them and add to them anyway. These are not growth stocks where I am betting on future earnings multiples expanding. These are income vehicles yielding over 11% and 12% respectively that pay monthly dividends and have maintained or grown their payouts while most of their sector peers have been cutting. The overvaluation is real, and I am going to explain exactly why it does not bother me the way it probably should. If you are building a high-income portfolio and want honest analysis like this every week, hit subscribe. I post real breakdowns on income investments consistently. And before we get into both stocks, quick question for the comments. When you are evaluating a high-yield investment, does the valuation relative to NAV or book value actually change your decision? Is it fair, or do you focus more on dividend coverage, non-accruals, and income sustainability? Drop your honest approach below. I reply to every comment, and I want to know how this audience actually makes these decisions. The first company is Trinity Capital, ticker TRIN. Trinity Capital is a business development company, a BDC. These are investment vehicles that provide capital to small and mid-sized businesses, particularly in the growth and venture stage. They earn income on those loans and pass the majority of it through to shareholders as dividends. Trinity checks a lot of the right boxes for an income investor. The current dividend yield is approximately 12%. They switched to monthly dividend payments less than 6 months ago, which matters for income investors who want consistent cash flow rather than quarterly lumps. Non-accruals, the percentage of their loan portfolio that is essentially non-performing, sit at just 1.1%. And despite investing heavily in technology-oriented startups, software exposure represents less than 10% of their overall holdings. That is a meaningful structural advantage over other BDCs who got burned by widespread software sector distress in the past year. Trinity has also been one of the best-performing BDCs over the past several years by total return metrics. The combination of strong income, a growing loan portfolio, and effective capital allocation has made it genuinely stand out in a sector where most players have been struggling. And yet many income investors will not touch it because the valuation is uncomfortable. The way you measure whether a BDC is cheap or expensive is by comparing its share price to its net asset value per share, the actual accounting value of the assets it holds on its balance sheet. If the stock trades above NAV, it is considered a premium. If it trades below NAV, it is considered a discount. Trinity's stock is currently around $17 per share, while the last reported NAV per share was $13.27. That is a 27.2% premium. By typical BDC metrics, that is significantly overvalued, one of the most expensive in the entire sector right now. So why would anyone buy it at this price when there are other BDCs trading at discounts? Here is the argument that changed how I think about this. Look at the BDC sector over the past year. Rising rates, falling rates, credit cycle stress, software sector implosion. The majority of BDCs have had to reduce their dividends, non-accrual rates have climbed across the sector, NAVs have declined. It has been genuinely difficult for most players. But if you filter only the BDCs that have consistently traded at a premium over the past several years, not a single one of them has cut its dividends since interest rates started falling. Not one. The premium appears to reflect something real about the underlying quality and consistency of these specific businesses. You are not just paying more for the same thing. You are paying more because the market has historically been right that these companies are run better. There is also a structural capital advantage to trading at a premium that most investors do not think about. BDCs are required to distribute most of their earnings to shareholders, which leaves little retained capital for growth. So when they want to expand their loan portfolios, they have two options: issue new equity or take on more debt. There are regulatory limits on debt, so equity issuance matters. When a BDC issues new shares while trading at a significant premium to NAV, something interesting happens. They are selling shares for more than the accounting value of each share. That immediately increases NAV per share for existing shareholders. It is accretive rather than dilutive. The premium cash raised goes into expanding the loan portfolio. That expanded portfolio generates more income than the cost of the new shares. It is a compounding loop that only works when the premium is maintained. Trinity has been able to use this mechanism even in the difficult environment of the past year, which has helped cushion the NAV impact that most of its sector peers have felt much more acutely. On their last earnings call, management also noted that even if interest rates continue to fall, which I personally think is less likely in 2026, the impact on their net investment income would be minimal. Their portfolio is positioned defensively despite the aggressive growth of recent years. The second company is Capital Southwest, ticker CSWC. If Trinity is impressive, Capital Southwest is in an even stronger position in my view. Their stock has not traded at a discount to NAV in over 5 years. If you have been waiting for a flash sale entry point on CSWC, it has not come, and historically, it has not stayed there long when it has briefly dipped below. The dividend yield currently sits above 11%, and it is paid monthly. But the detail that tells you the most about the underlying health of this business is the special dividend. Capital Southwest pays a regular monthly dividend, and on top of that, they pay a 6-cent bonus dividend that has not been reduced in nearly 4 years. Special dividends are always the first thing a BDC cuts when things get difficult. They are the financial equivalent of a canary in a coal mine. If a company is struggling, the bonus goes away before anything else. It gives management a buffer to protect the regular distribution and preserve NAV. Capital Southwest has not done that. 2 days before this video, they announced another special dividend. Their regular dividend is 109% covered according to their latest earnings call. Non-accruals are 1.1%. They have enough undistributed taxable income on the balance sheet to cover 5 months of their full dividend obligation without generating a single dollar of new income. These are not the metrics of a company in distress. These are the metrics of a company operating from a position of genuine financial strength in a sector where most peers are under real pressure. Like Trinity, Capital Southwest has also been able to issue equity this year while the premium remains elevated. That issuance has actively supported and in some periods grown their NAV per share at a time when the majority of BDCs have seen book values decline. The premium is doing exactly what a premium is supposed to do for a well-run business. It is giving management a tool to grow the portfolio in a way that benefits existing shareholders rather than diluting them. I hold both of these companies in my income portfolio. Neither represents more than 2.5% of my total holdings, because diversification across income investments is genuinely important, and position sizing discipline matters as much as stock selection. But both earn their place in the portfolio because they are producing the income I need them to produce while protecting the capital base I need them to protect. Here's the broader principle I want to leave you with. The idea that you should only buy undervalued stocks is not wrong. In most cases, it is exactly right. But income investing is not the same discipline as pure value investing. When your goal is generating reliable monthly cash flow from a portfolio over a decade or longer, the consistency of that income and the safety of the capital producing it often matters more than whether you got in at a 10% discount or a 10% premium. The BDC sector made that point clearly over the past year. The premium companies held their dividends. The discount companies often did not. Paying more for quality is only a mistake if the quality does not hold up. In this case, it has, and that is why I continue to own both. Now, the question I want in the comments, when you are evaluating a high-yield stock like a BDC and it is trading at a premium to NAV, does that immediately disqualify it for you, or do you look at other factors first? Drop your honest answer below. I reply to every single comment. Hit subscribe for more analysis like this every week. Let us build something that actually pays us.